All right, today we're tackling a big one. You've probably heard of them, Lemonade. They're this super buzzy insurance company that's trying to shake everything up with AI and a whole new way of doing things. The big question, though, is this. Is their plan a stroke of genius or just a massive gamble? We're going to dig into the numbers and see what's really going on.
I mean, let's be real for a second. Who actually likes their insurance company? It always feels like you're fighting them, right? The less they pay you, the more money they make. It's this built-in conflict, this tug of war. And that exact frustration is the problem Lemonade claims it's here to fix. So, their big slogan is literally, forget everything you know about insurance. I mean, that's a bold statement. They want to take this thing we all see as a necessary evil and somehow turn it into a social good. It sounds great, it sounds revolutionary, but how on earth do they pull that off? And, is it actually working? Okay, so here's how we're going to break this down. We'll start with their big promise. Then we'll look at the growth story that came from it. After that, we dive into the Wall Street reality, the hard financials. Then we'll cover the long list of risks, and we'll wrap it all up by asking, is this company a real disruptor, or is it a dud?
All right, first up, a new insurance promise. How are they turning this necessary evil into a social good? Well, what really sets them apart from the old-school giants like Allstate or State Farm, it all boils down to their business model. So here's the core idea. They're trying to get rid of that fundamental conflict we just talked about, where it feels like they win when you lose. Lemonade flips that on its head. They basically treat the money you pay them, your premiums, as if it's still your money, not theirs.
And this is how they do it. It's all about their give-back model. So check this out. Step 1. They take a flat fee. That's for their running costs, their salaries, their profit, everything. Step 2. The rest of your money goes into a big pot to pay out claims, and they use AI to do it super fast. Now here's the kicker. Step 3. Whatever money is left in that pot at the end of the year, it doesn't go into their pockets. It gets donated to a charity you get to pick. See the genius there? It completely changes the incentive. They're not motivated to deny your claim anymore.
Okay, so on to our next section, the AI-powered growth story. Because let's face it, this model is attracting millions. People seem to love this concept. And that love has translated into some absolutely explosive growth. Let's get into the numbers.
So get this. By the first quarter of 2025, Lemonade pulled in over 2.5 million customers. And that's not just some stat on a page. That's proof that their message is really hitting home, right? Especially with younger folks who live on their phones and are just done with the clunky, old-school way of doing things.
And all those new customers, well, that translates directly to financial growth. You're looking at their year-over-year numbers here. Their in-force premium, which is just a fancy way of saying the total value of all their insurance policies, that's up 27%. And their revenue, also up 27%. In this industry, that kind of top-line growth is, wow, it's really, really strong.
And they are actually walking the walk. That whole give-back thing, it's real. They just donated over $2.1 million to nonprofits chosen by their customers. So it's not just a nice story they tell. It's a core part of who they are. But, and this is a big but, a great story and super fast growth don't automatically equal a healthy, profitable company.
And that brings us to the Wall Street reality. This is where we need to do a deep dive into the financials. Because this is where the story gets a whole lot more complicated. You see, growth is fantastic, but Wall Street, they care about the bottom line. They care about profit and if this thing can actually last. Okay, let's talk about the stock price, because this chart tells a fascinating and kind of painful story. If you look at just the last year, you're probably pretty happy. The stock is up almost 60%, crushing the S&P 500. But, and you knew there was a but, let's zoom out. Look at the 5-year picture. The stock is down almost 44%, while the market basically doubled. And since they went public, down 47%, while the S&P is up over 100%. So what does that mean? It means if you are an early believer, an early investor, you're still deep underwater. And this slide right here is the why. It's the perfect picture of what I call the unprofitable growth story. On the one hand, you've got that awesome 27% revenue growth we talked about. Love to see it. But then you look at the net margin, and it's almost negative 39%.
Let me put that in simple terms. For every single dollar Lemonade makes, it's spending about $1.39. They're literally losing money on every sale. This is a classic Silicon Valley playbook. Burn cash to grow fast and hope you figure out profitability later. But for now, they're bleeding money.
So because of all this, you get these two totally conflicting views on what the company is actually worth. On one side, you have analytical models, like this one, that look at the company's potential future earnings and say, hey, wait a minute, the stock is actually undervalued by 18%. But then you look at what the pros on Wall Street are saying, and their consensus is basically reduce your holdings with the price target way, way lower. It's a real tug of war.
And if you look closer at that Wall Street view, well, it's not pretty. The average rating is reduce. You've got 5 analysts saying sell, 1 saying hold, and only 1 lone voice saying buy. But maybe the biggest red flag here? Insiders are selling. We're talking about significant selling from people inside the company and major investors like SoftBank, and when the people who know the company best are heading for the exits, you gotta ask why.
So that brings us to the next big piece of the puzzle, a litany of risks. And if you want to know why Wall Street is so nervous, you don't have to hire a private detective. You just have to read what the company tells its own investors.
79. Just let that number sink in for a second. In their latest report, Lemonade disclosed 79 separate risk factors, 79 different ways their business could get derailed. Now look, every company has risks, especially a young one, but 79? That is a lot.
And this chart breaks down where all those risks are coming from. You can see the biggest chunk, over 40%, is in financing corporate stuff. You know, the fact that they keep losing money, their stock price is all over the place. But look at the next biggest pieces: legal and regulatory, and tech and innovation. And that gets right to the core of what makes Lemonade, well, Lemonade.
And here's a huge one, right from their own filings. What if a state regulator looks at their give-back program and says, you know what, that's not a donation, that's an illegal rebate? The company admits that if that happens, they might have to scrap the whole thing. The very program that's at the heart of their brand could be outlawed. That's like an existential threat hanging over their heads.
Then there's this other really interesting wrinkle. Lemonade is a public benefit corporation, a B Corp. That's not just a label, it's a legal structure. It means their management isn't just obligated to make money for shareholders, they're also legally required to pursue their social mission. So what happens when those two things clash? What if doing the right thing means making less profit? The company straight up says there's no guarantee that shareholders will come out on top.
And of course, there's the competition. They're not playing in some quiet little sandbox. They're going head-to-head with absolute giants. We're talking Allstate, Farmers, Liberty Mutual, companies with way more money, way more customers, and decades of brand recognition. It is the classic David versus Goliath story, except in this version, there are like 10 Goliaths.
So that brings us to the final showdown. Disruptor or dud? We have to weigh this incredible, inspiring promise against the cold, hard performance.
And this slide really lays it all out. The two sides of the Lemonade coin. In one corner, you have the promise. It's a beautiful story, right? AI powered everything, a brand people actually like, insane customer growth, and a real mission. But in the other corner, you've got the performance. And it's a tough look. Constant losses, a stock that has punished long-term holders, massive competition, and a scary number of risks.
Which leaves us with the $1 million or maybe $1 billion question: is Lemonade's high-tech, high-growth, cash-burning model a truly sustainable way to fix a broken industry? Or is it just a high-risk gamble that's destined to run out of road? The answer isn't clear yet, but it's one that will define the future of this company and the wallets of anyone brave enough to invest in it.